Hi guys, in my last video I spoke about three separate indicators that were pointing to a potential stock market correction in the near future, and in the end I did share my view as to whether I thought a stock market correction was coming or not. And in this video, as promised, I wanted to talk about a few different asset classes and ways that we can actually hedge our exposure to the stock market while staying invested. So hedging, what does it mean to hedge? It simply means to protect oneself against some sort of loss, whether it's financial or not. But since we are talking about investing and stock market, when it comes to hedging, we're talking about reducing some sort of potential financial loss to our investment portfolio. In my day-to-day work as an investment strategist, we talk about hedging and apply this hedging all the time for our client portfolios. The very first aspect of hedging that I worked on earlier this year was against inflation. We looked at potentially different types of asset classes that we can invest in on behalf of our client so that we can hedge any sort of negative impact that comes from rising prices. Anyway, in this video, the hedging that we will talk about is the stock market hedging. So how we can actually reduce our exposure to whatever is happening in the stock market while staying invested. So I am thinking of ways we can reduce impact of whatever the stock market returns. If it goes up by 20%, we will get less than 20%. If it falls by 20%, we will lose less than 20%. Technically, hedging can be full or partial. If you want to completely detach yourself from whatever the stock market is returning over the next few months, you can go for a full hedge by investing in an inverse ETF, which gives you return of the opposite of what the stock market is doing, or go into a total return swap contract with someone else, where you would exchange your stock market return with someone else's returns that may be linked to bonds or commodities or any other types of asset classes. But those type of investments require some sort of expert and professional knowledge. But in this video, I do really want to keep it fairly easy to follow for retail investor. And so in my video, I'm gonna go for a partial type of hedging, which we can achieve through a well-diversified portfolio. Creating a well-diversified portfolio is pretty simple in principle, but can be quite tricky when it comes to actually implementing it. For example, how do you know that you have reached the optimal level of diversification in your portfolio? If you hold a 20 stock portfolio, will adding another 5 stocks really help? It may or it may not, because if those 5 new stocks closely mirrors the rest of your 20 stock portfolio, then you will not get the desired benefit. The same thing goes with index funds. If you hold S&P 500 index fund and want to diversify to hedge those exposure, will adding a global index fund that tracks, say, MSCI World help you do that? Most likely not, because over 60% of a typical global index fund is made up of US stocks, and so those will be highly correlated. And so the trick is to invest in assets which are least correlated, especially negatively correlated to your current investment stock portfolio. And if you manage to do that, it will bring the total level of portfolio risk for your portfolio and really help you manage those downside risks. And it precisely happens because of this formula here. This is the formula for total portfolio risk or standard deviation of your portfolio. This is a simplified formula which assumes that you're only holding 2 different types of investments. It can be 2 different stocks or stock market index and a bond market index, or 2 different types of stock market index. What is important here is the R. R here stands for correlation. This is the correlation between 2 assets in your portfolio. If this R is 0 or negative, as you can see according to this formula, it will reduce the total level of standard deviation or risk of your portfolio. And this is precisely how going for an asset which are negatively correlated or has least correlation with your current asset will help you manage those downside risk and hedge your exposure. So in plain English, let's see what goes up when stocks go down. Let's start with gold. It is often talked about as a safe haven asset class that should hold its value when the market is down. This is because gold is a physical commodity which has some use. During times of panic, when stock market is weak, investors would often move their allocation from stocks to gold. During those market corrections, the best case scenario for any investor is to have some sort of positive return rather than a double-digit negative one. Let's run some numbers. Here I've crunched some numbers and put them into a chart. I've got returns going back nearly 20 years. The blue line is a rolling 12-month correlation between S&P 500 and gold price, and the red dotted line shows you the average correlation over the whole time period. For gold investment to be a good hedge against stocks, we need the correlation to be very close to zero or negative. We can see that on average it's been a pretty decent hedge with average correlation of around zero. However, what we can also see is that the relationship between stocks and gold has not always been stable. There are times when both were positively correlated, like around here between 2016 and 17. But for us, we care about times when the stock market was down. To help us visualize that, I added this yellow shaded area here. This area highlights time when the stock market was down more than 5% from its 12-month peak. So around GFC or global financial crisis, you can see that gold did indeed help us to hedge our exposure as correlation stayed between 0 to negative 60%. Again in 2011 and 2015, having gold in our portfolio helped. So what we can take away from this chart is that gold, yes, it does help us hedge our investments, especially during stock market crashes, but the relationship is not always stable. And that is because there are other drivers which impact the price of gold. For example, US dollar. US dollar is heavily correlated with prices of gold because gold is generally priced in US dollar. However, looking back even further, gold prices have generally been negatively correlated with the stock market 6 out of 9 times when the stock market was down more than 19% since 1976. So gold tend to hedge, but in a volatile way, and it is not always guaranteed. Next, we have bonds. Traditionally, bonds are known to hold negative correlation to stocks. This is because, by design, bond prices are negatively correlated to interest rates. If you think about a typical bear market, it is generally tied to the economy not doing well. And so, during bear markets, central banks tend to cut interest rates to help the economy grow. And low interest rates increases prices of bonds, making bonds to outperform stocks. Although the timing of these things happening is not always perfect, but this is why typically investors move money from volatile stock market to government bond market when they fear a potential market crash. Realize that I'm saying government bonds and not any other type of bonds, because generally this type of hedging or relationship tend to hold true mostly with government bonds, because government bonds are known as the safest way to lend your money, because you're giving your money to the government and hopefully they won't default, especially if you are buying developed market government bonds such as those of the US called the Treasury, or in the UK which are called gilts. So when you are investing in government bonds, you can be sure that you will at least get your original money back in full if you hold that bond to maturity, plus the interest cost that the government has promised they will give you. This is why investing in bonds gives you limited downside compared to investing in stocks. But let's see how government bonds tend to help you, especially during those market crashes. I have a similar chart here like I had for gold, but this is showing correlation between S&P 500 and US 10-year government bond. And I was able to find data going back to 1990, so plenty of data points. Notice that average correlation is negative, and most of the times correlation did remain below zero, except a couple of times when the relationship broke and we see a spike, for example during 1994 and also just before the dot-com crash. The stock-bond correlation was pretty high and positive. However, do notice that during the actual dot-com crash, the correlation did turn negative and helped stock investors to hedge their position. But here is a caveat. Before anyone looks at this chart and decides to start investing in bonds, there are a lot of other factors that we need to take into account before investing. For example, the current starting interest rate. As there is always a negative correlation between interest rate and bond prices, if you buy a bond right now with interest rate close to zero, it means there is a limited upside from this investment. So this plus many other factors needs to be considered and analyzed before deciding to invest in bonds, just like you would do with any other investment. Now, moving away from bonds, let's go to my number 3, which is to look at other parts of the stock market that can also help us to hedge our current exposure. So looking at sectors and regions. Let's go back to my reference to dot-com bubble, because that was a great example of getting portfolio diversification within stocks. This is because 2000 dot-com bubble was driven by tech companies, and what you would notice is that it did not affect every area of the market in the same way. Large cap growth and technology companies plummeted during 2000, while value stocks did not. In fact, it returned positive. For example, the tech-focused Nasdaq index fell 39% in 2000, while the Wilshire 5000 large cap value index gained 17%. What this means is that it is possible to hedge exposure within the stock market itself. So as a proxy, I ran correlation between S&P 500 and the utility sector. Utility is a defensive value sector because it is our necessity. You'll see that the overall correlation is generally positive between utility sector and the overall S&P 500. And it is not as directional as we saw with bonds and golds. However, they do get the job done sometimes. Just as I was mentioning, they did help during the early days of dot-com bubble, but then not so much during 2008. And the overall relationship is very unreliable. But what I hope you can take away from this is that there will be pockets of opportunity within the stock market itself, which can help with hedging our overall stock market exposure. And finally, in my personal opinion, investing does not always have to be in the financial market. So in stocks, bonds, or index fund, investing can be on anything really, something that you know that can give you some sort of positive return in the future. So if you are worried about investing a lot of money in the stock market, whether it is now or in the future because of whatever reasons, maybe because you just don't have the risk appetite to invest a lot of money in this volatile place in the financial market, you can do other things with it. You can invest on yourself, in your career, or in your education, or in your hobby. Perhaps it is that course that you've always wanted to enroll yourself to, or getting an education, or even buying a camera because you like to take pictures and photography is your passion or your hobby, and it is something that you can also monetize at some point in the future. So who knows, really, the choices are endless. Everyone is in their unique situation and we all have our different needs. So all I'm gonna say is that do keep an open mind about your money and how you choose to invest those money, and don't feel that you're under pressure to follow any crowd or do a certain thing because that is the right way to go. And that is all I had to say for today. Until next time, do look after yourself and your money.